Nice to see everybody here tonight. I'm going to give you a bit of an introduction as to the topics we're going to be discussing tonight. And then I have to my right esteemed colleagues within the financial industry who are also going to give their views on various different items on the innovation agenda. So the purpose of tonight's event is really to talk about what is going on, what are the latest trends, in financial innovation. What are we doing as an industry to boost the democratization and access for all individual investors to get involved in more asset classes, to benefit from cheaper, faster ways of transacting and improving their consumer outcome effectively. So why don't I just begin with giving a bit of a background about myself and what WiseAlpha is doing. So WiseAlpha is basically the leader in democratizing the bond market. So we're the only firm in the UK who's tackling this issue. And it's a very important issue because access to corporate bonds has been a very serious issue for investors for a very long period of time. And so our solution is very much fractionalizing, breaking down large blocks of bonds which trade in sizes of 100,000, which effectively prohibited individual investors from accessing that market. So that's a vertical that we think is incredibly important. I'll discuss that further tonight. But there are similar initiatives going on all across finance. And I think it's very important to hear from leaders as to what's happening, what they're doing to drive forward. Then it's also trying to encourage all stakeholders who are involved in this process, and that includes everybody here tonight. You're all beneficiaries of some of the innovation that's going on. I think there's an important role in trying to give us all the ability to understand what's going on and work together on that. I would say that over the last 10 years, we've really seen a massive drive towards direct investing. Technology has been at the forefront, so people were investing direct via apps, getting access to new products that they've never seen before. Things have become quicker, faster, cheaper. Neobanks have started to emerge. There's been a huge amount of investment and stakeholder capitalism involved in the sector. That enthusiasm has continued, and I do think it will continue on the path that it has been. But the role is also of our discussion tonight is to think about what are the impacts of other stakeholders such as government and regulators in trying to maintain that momentum. So that'll be an interesting topic that I'll throw out to the panel as well. So before I begin, I just want to introduce the individuals who are helping me out tonight.
Andrew Foster, I am the founder of a company called InfiniteX. We run the technology for private venues for unlisted securities. Our venue you may have heard of, JP Jenkins. It's been around for 30 odd years, providing a solution for unlisted assets. We're working with the WiseAlpha team on a few quite cool initiatives, and we speak to them fairly often about things that are going on.
Evening everyone, my name's John. I run the marketing team at Crowdcube. I like to joke that I love crowdfunding more than anyone in the world. Reason being I've worked at 2 platforms, so I've got about 5 years experience growing 2 crowdfunding platforms at Crowdcube for about 2 years. Before that, I was with Front Funder in Canada, so interested to share with you a little bit kind of what the regulatory framework is like there, how it's different to here. Broader background, spent around 10 years in the growth marketing game, some really nice successes, some massive failures as well, which I learned a lot from.
Right, so the first topic we're going to touch on is what do you think are the most important upcoming innovations in the fintech area? What more could be done to enhance financial innovation in the UK to maintain its leadership and competitiveness in financial services? As one of the, vanguards in the democratization of access to unlisted equity and helping startups and UK PLC. John, why don't you give us your views on what you feel about innovations in your area and what could be done further to kind of bolster that?
Our mission is to help democratize access to investment, and everyone that works at the company is very driven and kind of believes that time was your access to investment was predicated on sort of how big your checks or your wallet was and kind of how well stocked your Rolodex was. We wanted to change that and give everyone access to investing and sort of help educate and inform people on what private market investing is, how it's different to public market investing, and how it can really change the company's life but also your own. The 2 main reasons people are investing is really with the head and with the heart. Kind of either a company you back and you want to see succeed, but also at the end of the day is your money and you want to see a return on that. One of the main things that we've seen, and I suppose quite timely with the 8th of March coming up, is we worked really hard to address the gender imbalance when it comes to the investment space. I think it's well documented that the number of female founders or female-led businesses that raise capital is vastly behind the male number, which needs addressing. And being a marketplace on the other side, we look to boost female participation. So I'm happy, I'm proud to say that 25% of our investor base is female, which it should be 50-50, and we strive towards that. We've got a long way to go, but it's way above sort of the sort of market average, if you will. And the last couple of years, it's been above 30%, so it's a number that's trending in the right direction. I think when it comes to what we can do, it's just educating more people, kind of giving people more access to investment opportunities and kind of really spreading the word with events like this.
And what do you see as the kind of future in terms of trying to, bring more different types of capital to your customer base? What other innovations are going on? I noticed that you're doing a big push on VCTs at the moment. Is that something that you could give us a bit more color on?
As I'm sure everyone knows, the investment landscape has changed quite a lot. It's a bit of a cliche to say that unprecedented times and things have changed, but if you rewind 3 years ago, I think it was much more of a boom economy and people were raising capital and it was sort of growth at all costs, if you will. Now people are much more aware of sort of profitability and unit economics. One of the things that we've done to respond to that, and the reason I mention it is we need to be kind of dynamic and sort of see what's in front of us, is diversify our offering. I think people are much more savvy, investing as much with the head as with the heart now, and our fund offering is a way to do that. Again, the typical problem you get when it comes to funds is access and investment minimums. You're looking at least 10,000 for an EIS fund typically, I believe. An SEIS fund is about 20,000. So we look to do partnerships. What we're able to offer is distribution. So we have an investor base of 1.7 million people spread across Europe. The funds have obviously the portfolios that are attractive and appealing to people. So we've launched a few of those, which we can talk about in a minute.
What I've noticed is actually there's a lot of firms who basically built tech up to bring in a whole sea of retail investors into the private equity space, and then you've also got a large number of firms who operate at the big end of the scale, traditional private equity. That kind of space is narrowing. With firms like Moonfair and Titan Bay, who are kind of focused on the large private equity end of the spectrum, where do you see Crowdcube and also Infinitex, which obviously you're focused on the kind of medium-sized company end of the unlisted equity market? How do you see the space evolving over the next 5 to 10 years?
First and foremost, we've got to look at who our clients are. Our clients are firms that are medium to large size. They're not the large kind of top 100 firms. And over the years, the public markets have almost, in a way, done a disservice to those sorts of firms. They've become too big and too cumbersome to be able to provide the solution that they need. And so what we're trying to do is provide a solution to our customers that are those medium-sized firms, and trying to provide them with innovation, trying to provide them with solutions that they need, things that they need for their capital process. That then translates to the end investor, and making sure that the end investor can go along for that journey and that they can participate in a company at the right time for them. That, of course, is only possible if the customer is educated, the end investor is educated enough to be able to understand their customer, that firm, understand where they are in their journey, understand where they're going and what they're doing. So I think a lot of the future and the innovation in the future is dependent on education. And I think that it starts at the ground level. Schools should be spending more time on educating scholars. There should be more put towards making people more financially literate.
And John, do you ever see a situation where Crowdcube might be, offering not just VCTs, but funds of a much larger focus, for UK PLC?
It's definitely something that's on the radar that we see, that we may explore at some point. I suppose we only really launched funds last summer, so we did 2 from Octopus Investments. So we did the Apollo and the Titan VCTs, which I think are the 2 biggest on the market. We raised, I believe, 1.4 million for Apollo first time round, and Titan was 1.1 from around about 700 investors each. So for us, that validated the concept that there was appetite for it. And again, we're doing more now. We just completed Hatch's SIS fund. We've got Fuel live on the platform now, and we'll see where we take it from there. But I think to your point, I completely agree that education is huge. There's a bit of a gap. I'm not quite sure what the answer is. Maybe we can discuss. But things like, for example, EIS and the tax breaks. We have a fairly savvy group of investors, but even then, there's a lot of people who don't claim. And we recently launched a partnership with Tax Scouts, which is a digital tax service, and just embedded a little notification to our investors to say, you've done X number of investments in the last 5 years that are EIS eligible. Did you know you could claim? And in about, I think, 2 months, £500,000 was claimed in unclaimed tax relief. And this is a savvy group of people. So if you take that as kind of the upper end, as you say, there's this whole load more to be done further down the scale as well.
I'm going to just move on to a slightly different topic now, which is more what I alluded to earlier. What could be done within the UK to keep pushing forward more financial inclusion for investors? Because I think that's something that's both close to our hearts. The reason we set up WiseAlpha, for example, was to effectively give all investors access to corporate bonds, which they have never really had that ability to do. Now, obviously, both of you are kind of pioneers. JP Jenkins is probably the oldest liquidity venue in the UK. Targeting unlisted equities, and obviously, Craig, you've done a fantastic job in opening up the entire kind of startup and medium-sized space to investors. What can we do as industry leaders to push government and regulators to continue this democratization process? So, who's going to take that one? That's a nice one to continue with.
Happy to have a go. I'm not sure that I've got an answer to it though. I think the challenge with the regulation side of things is that any regulator is incentivized to look for the risk, as we all know. And so they're not incentivized to look for the opportunity. That's their job. No regulator is going to get a pat on the back for having created a new innovative stock that introduces risk. They're going to be, by nature, conservative. I know I'm preaching to those that know, and that's their job, right? To look for the risk, to prevent things that may be perceived or may not be, but to prevent the unknown from happening, right? And so I think chasing after the regulator is perhaps not an answer. I think that there should be a focus on innovation within our industry that should be led by those that operate in the industry. It should not be by the old guard necessarily. It shouldn't be those that have been around for many, many years. By that I mean to say that JP Jenkins should be part of that conversation. So I think it needs to be those that are the innovators, that can look sensibly at risk, that can sensibly manage risk, but not be hindered by those that are disincentivized from introducing innovation.
John, maybe you could talk about what as an industry, with other players who are in the market, what we can do to kind of build a stronger association footprint, in order to push forward lobby with government members. What are you doing? What is Crowdcube doing on that front? And what scope do you see to kind of continue this kind of process to open and educate and give more access?
It's a good question. Again, I can give some thoughts. I definitely can't answer it fully. I think for us, and again, I touched on Canada earlier, and I saw this firsthand, and I know it happened in the UK as well, is working with the regulator. As you said, they have a job to do as well, which is de-risking things, and they're also there to do their job. So explaining it, how it all works and taking them on the journey. I know when Crowdcube first emerged and got regulated, they did that hand in hand with the FCA. It wasn't, we're going to do this, you're going to follow suit and see what happens. It was, let's take on the journey, let's bring you into the process, see how it can all happen. I think the first raises on the platform took around 6 months to bring them in as well. The fastest raise, I think, was Monzo, which was 34 seconds. So doing it iteratively. I think the second thing, we're licensed across Europe, and again, France is I think a textbook case of how government has really bought into the whole idea of being a leader in innovation. And so I know that the Crowdcube CEOs have met with members of French government to discuss the benefits of tax relief, which wasn't as prevalent there as it is now. That legislation has now been brought in. They're very willing to do it. They see particularly deep tech as a space that's going to innovate a lot, and they're very supportive with tax breaks there. So probably not a direct answer to the question, but danced around it a little bit.
From my perspective at WiseAlpha, we obviously, are in an industry which is very much a club market. so we're almost the lone wolf in the sector. But I think one of the things that we plan on doing is very much highlighting the international competitiveness of the industry, highlighting what initiatives are going on around the world, so that the UK is very well aware. So policymakers, not just regulators, but policymakers both within government, as well as who are on the outside, ex CEOs of fintechs who are now retired, who are also policy-minded, are aware of some of the innovations which are going on internationally. Because I think one of the strong points for the UK is that it's always prided itself on being a leader, and wanting to maintain its strong position within financial services. I mean, that is our core competency as a nation. And so when you touch on those heartstrings and you make sure that your particular financial area is top of the agenda by pushing and talking to these types of people, I think we're gonna start to see a shift to kind of re-emerging from I guess the last few years, where, being honest, I think innovation has been not at the bottom of the agenda for the regulator, but other priorities have taken hold. And I think by pursuing that angle with government and policymakers, highlighting the international competitiveness issue, and focusing on our leadership to maintain our global position, I think that is what is going to continue to get innovation on the agenda, and ultimately get financial inclusion moving in a stronger way. So that's one of the things that we're working on right now. There will be further updates over the course of the year. Fintechs are obviously a new breed which have developed quite aggressively over the last 10 years. Increasingly, existing incumbents, banks and institutions are realizing that they have to kind of get with the times, and technology has been a heavy focus area. But at the same time, this is not necessarily a competition between both. There's a lot of synergy, and actually, we see a lot of institutions partner with us. So for example, WiseAlpha, I mean, we're an innovative tech company. We have a solution which banks can't easily replicate. So, there is a natural synergy between us working with partners, banking partners, to provide our technology to them. And that's something that's been very important to us over the last 12 to 18 months. We've been working with and integrating with a large bank to offer our solution. What do you see as some of the, I guess, the USPs or the reasons for why banks and institutions and other types of player, which are slightly different to yourselves, what are the reasons you see as, or key things that help kind of a synergistic partnership model?
I can't honestly answer this question without referring to a great book about exactly this topic, The Innovator's Dilemma. The bookworms among you, I'm sure, would have read it, Clayton Christensen, where he speaks about and does a lot of case studies and analysis on how large firms are unable to innovate within themselves. They're not incentivized to innovate within themselves. And I can't recall an example of something within a bank, but I think the lessons in that book are still relevant to your question especially. And I think that the synergies often are where a small firm, like a small ambitious firm, can innovate with a small team, aggressive, an ambitious team. They can innovate outside of a bank or a financial institution, and then provide those solutions directly and at a far lower cost, probably far more innovatively, still regulated, still doing things the right way. So I think there are lots of synergies. Of course, it all still comes back to the investment hypothesis at the end of the day. Why do people want to buy assets in our worlds? Why do people want to participate? What is the problem that's being solved? And if that's wrong, who cares?
You recently announced a partnership with Winterflood, and I think you've been making a big push to, bring other institutional brokers into your, partnership model or your marketplace. What are the key things around that, that have been important, and how is that progressing in terms of bringing more liquidity access, to a wide array of customers?
I guess there are two parts to that question. How is it progressing? It's really good. For those of you that know the team at Winterflood Securities, they're really good guys. They're supportive of what we're trying to do. I think they understand and see that the unlisted or the private markets are taking off.
and so they want to be part of that journey. I would encourage you to speak to them. They are a great team. And so the relationship is progressing really, really well. How did we make it happen, and what was the catalyst behind it all? Like most things, there are often some good relationships, being able to talk the same language, know how things fit together. We within JP Jenkins and within our technology at InfiniteX is that we're not trying to introduce something new and revolutionize something overnight. It's more an evolution than a revolution, and these things take time. So we've got to kind of fit into what the market norms are and then change and nudge things forward slowly. And I think that's what we're able to do, mutually with the Winterflood's team.
I'd say for us, being kind of a relatively small company in the scale of an international bank, it has to be sort of mutually beneficial and symbiotic. So what we can provide is a large group of retail investors, sort of tried and tested, owned media way of reaching them. And then what larger institutions can provide that we don't have are those sort of investment opportunities like a VCT, or where at a bank, this is nothing concrete, but kind of things we've explored is accelerators that banks have for innovative fintechs, for example. So, there's a deal flow potential there where companies get a grant, and part of that grant is the lead round for a crowdfund investment, for example, and then we're able to provide the distribution, which is mutually beneficial to both parties. So exactly as you said, not trying to upend anything or disrupt per se, but kind of joining forces is how I see that working.
I mean, where I sit, I see technology as almost the key driver of what is driving institutions to partner with fintech. I mean, that is the key differentiator. If you've ever worked in institutions like wealth managers, funds, or even banks, you know how cumbersome the internal processes are, the number of teams that are involved, in any change to existing ways of doing things. New systems, new processes, they take an extraordinary amount of time. And it's actually not the amount of time it takes to actually just, implement a final solution. It's the actual process of creating that within the frameworks that they have. And that's what takes a lot of time. And so, I see an enormous amount of scope for, continued, institutional partnerships with fintech. The one thing that, large organizations have, is a large customer base that they've built up over 30, 40, or even longer years. But the one thing they don't have is that entrepreneurial mindset. Now, I know that there are certainly, some institutions which have been hiring aggressively to try to bring that type of innovation, that entrepreneurialism within in-house. But I think it's in the financial space in particular. It's the compliance, it's the regulation, it's the internal processes which slows everything down. And so that is why fintech will continue to do extremely well, and why I think it's going to be beneficial for partnerships to occur in the future as well, or continue. What is your belief system around the inclusion of all retail investors, not just high net worth or sophisticated investors, but what is your belief about whether all retail investors should have access not only to the education but full access to all types of products, obviously done in a very carefully crafted way to protect investors' outcomes? But what is your belief system?
Retail investors should have access to everything. They should be able to make their own decision effectively, buy their own food, choose their own whatever it might be. And the same is true of investment assets. That should, in a country like this, go without saying. I think the foundation of that is making sure that they understand what they're doing, that they're educated, that they're warned, and that they're protected when they go into that. There's opportunity, there's risk, there are all of those factors that fit into this. It would be ridiculous to say that someone shouldn't have access to an investment vehicle purely because they are only of a certain ilk. It's about the education behind it.
I completely agree. I think, as we said at the start, sort of democratizing access is pivotal. It's kind of why we do what we do. That said, you need kind of checks and balances there to help you along, and that's what the regulator exists for. So, talking from Crowdcube's perspective, every new investor that comes onto the platform is required to do a self-assessment test, which is not that difficult. But of course, if you're not able to pass that, you shouldn't really be investing. We do have a duty of care towards people as well. Alongside that, the FCA changed the rules about a year ago, so any new investor has to wait 24 hours before they complete an investment. You will see risk warnings plastered all over our website, which as a marketer kill me because it's terrible for conversion, but I actually fully support them, and I think it's really important to have those risk warnings there and to make sure that people make wise investment decisions. Ditto, every sort of raise that we have is verified by our due diligence team. All claims are verified, as I'm sure you'll know from having done that fund process. But it's really important to get kind of wider buy-in and make sure that people do have access, but in the right way, I think.
I think it's incredibly important to make sure it's done in the right way, because obviously, investors losing money tends to be, the big focus for regulators, and can effectively, sometimes scupper initiatives in the market. In my view, I think, all the major key asset classes should be very widely available, with limited frictions. There should be a way to create an opportunity nationally, for people to educate themselves on different financial products. And there's a way to do that on a centralized basis, which I think would be much better, for all firms, rather than, going to every individual, platform and trying to go through a test or a whole process. If this was centralized, at an industry level or government level, then I think that would reduce all the frictions. And so that's something that I think, regulators might want to consider in the future, and certainly something we'll be talking to them about, over the course of this year. But in general, where we come from, WiseAlpha, it's very much a focus on kind of simple vanilla products. Corporate bonds are very mainstream. They are used and employed by all major companies. FTSE-sized companies, all have, whether it's investment grade or even slightly riskier types of bond, in place. They all partake in that market, and unfortunately, the level of access, obviously, for corporate bonds is not there for retail. So, for example, you can buy a card of equity, which is the higher risk element and security in a company's capital structure, but you can't buy their bonds except on WiseAlpha. Now, obviously, we want to see that develop further, but there are certain asset classes which I think should be an absolute priority, both for governments and regulators to enact changes in. And certainly there are much better ways, I think, to reduce friction, and I think we can all agree that that's probably the necessary way to think about things going forward, is to keep inclusion, but do it in a way in which investors are given the opportunity to educate themselves and also to take responsibility for their decisions. I just want to thank quickly both John and Andrew for their discussion. Okay, so Michael, you've obviously listened to us tonight talk about fintech and the wonderful innovation that's going on in the markets and what we're trying to do to open up access. What I wanted to do is step back and just take a little bit more of a, as I said, an institutional view of things. So Fidelity, obviously, a large global multi-billion manager, across all asset classes. So first of all, we'd love to get your views on, fixed income in general, right? But we'd also just like to think about, what is important to Fidelity? How do institutions think about, improving their market position, developing their products?
Fidelity's an organisation that covers historically the public markets very, very broadly. We're in 25 countries, have global coverage both on public equities, fixed income, sovereigns, and we've been in the private markets for a very long time, in fact over 50 years, but we've more recently launched a private market strategy to be more mainstream in our capability. And the reason for that is because, as we've discussed today, clients are more and more wanting access to the broad economy and not just the public markets. And historically, if you think about people's access in their private portfolios or in their pensions, it's been very much 60-40 approach, equities, public fixed income, and that's about it. Occasionally you'd have some allocation to alternatives for high net worth. And as we've seen the markets develop over many years, we've seen really an evolution in demand, starting with the institutions, so endowments in the US and large pension funds moving more and more to private markets. And we're now seeing that that trend being followed more on the wealth side and retail side. And so, you know, we're very much looking to build capability and offer that to our clients. And since client demand is very much increasing in the private market space and having that broad coverage, we're offering that as well.
It's interesting. I noticed that there's been a big push over the last 10 years into private credit as well, you know, as an alternative to, you know, what I call public credit, or, you know, corporate bonds, high yield, investment grade. You know, how do you see the dynamics playing, you know, out between the two different ways of getting access to fixed income? What are the pros and cons in your view?
So the key differences between private credit, for example, and public credit is number one, regulation, information disclosure, transparency. So you know, in the public markets, and you know, very much what WiseAlpha has on its platform, you've got very standardized structures that have heavily regulated approach, where there's specific rules around reporting requirements, disclosures, etc. And so, you know, those safeguards are in place. When it comes to shifting towards the private markets, there are regulations in some parts of the market, but it's very much a professional market where, for example, in private credit, you know, if you're structuring a loan, you need the specific skills to assess the business you're lending to and structure that transaction and manage that. And then when things go wrong, be able to have the skills to work that process out. So I think there's differences in the structure and approach, but also in the skills required. You know, if you're an investor in private credit, because you could be pretty much investing in any type of instrument to any type of company, I think the gap in terms of education and knowledge is you know, miles apart from when you're talking about public credit. In terms of what that offers clients, on the public side, you've got tremendous liquidity. You know, you can pretty much buy and sell your asset any day, and there's a price for it. On the private side, it's priced by appointment. If you need to sell, you need to find a buyer, a bit like finding a buyer for your house. And so, so I think, you know, again, it's horses for courses. But I think what people, especially our clients on the wealth and institutional side, increasingly looking to do is allocate to the private markets, because they're realizing, well, in my investment portfolio, why do I need daily liquidity? I need daily liquidity for a portion of my portfolio, but if I'm saving for my retirement or the future, or, you know, my kids' university, I can afford to lock my money up for 5 years, 10 years, 15 years, or my retirement. And therefore, if the private markets are offering me that illiquidity premium, why don't I capture that premium and take the lock-up approach? The other thing is, you know, typically the high-yield bond market, for example, is a fixed-rate product. And I think the private markets, which are mostly floating rate, offer that diversification from fixed to floating. Parts of the high-yield bond market have floating rates, so you can look at that as well. But I think that is also a different approach. And what you saw when we've seen in 2022, when interest rates rose significantly, that can impact the volatility of portfolios when it comes to fixed rate products, which isn't really the case on a floating rate product. So that diversification is quite helpful.
Just on that point, so obviously, WiseAlpha, we're focused on, you know, public credit, which is all pretty much fixed rate. You know, what scope do you see for you know, the penetration of, I guess, private credit being made available via platforms? You know, so that a wider audience can access that. You know, what are the barriers to that? What is the mentality from, you know, institutions like Fidelity to kind of opening up access to that type of asset class as well?
The barriers are coming down as we speak, because regulation is evolving, and you've got in Europe something called the LTIF, which is I won't go into the technical detail, it's a UCITS Part 2 type structure, which is a common structure regulated in Luxembourg, and you can use those vehicles which are specifically, or regulation within those vehicles specifically designed to offer retail clients access and may I specify qualifying retail clients, access to private markets. And so regulation is moving in that direction, and we're expecting the LTIF 2.0 to come out, and there's specific requirements around liquidity, eligible assets, and this will offer wealth clients or retail the ability to invest in private markets broadly, not just private credit. But the idea is that these funds are open-ended, and they will have specific liquidity provisions, and so managers will need to meet those provisions and manage that accordingly. So, but that's very much access to a managed product. Yep. The market's also evolving where investors want choice, just like borrowers want choice when they're borrowing money, whether they borrow from the public bond market, where they get financing from the equity market, or indeed financing from the private markets. And equally, investors need choice. So whereas some investors want a managed fund, and that would be on the equity side or fixed income side, and there's value to that. Equally, there's some investors who want access to private markets in managed format or to choose themselves. And I think there's scope for innovation and regulation to develop in a way that offers investors choice in all those different elements.
I think that's really interesting. I mean, if I think about the kind of peer-to-peer lending space, which is also a vertical, which has seen a lot of interest over the last 10 years, and there's been a lot of platforms that have developed around that, where individuals can lend directly, to UK borrowers, typically kind of small, medium-sized end of things. How do you see that type of market, or how do you see the kind of, the example that market is set, vis-a-vis the kind of, I guess, higher end or large, medium to kind of large company lending that you're focused on at the moment?
So I think there's a few different dynamics at play at the moment. Firstly, one is there's a absolute trend, and it's been going on for some time, which is especially prevalent in the equity markets, which is a shift to passives. That trend continues also in the fixed income market, but what we've seen is actually, especially since 2022, an outperformance for managed fixed income funds, which is quite interesting. I think there's also the other element, which is complexity. When you're dealing with very large companies, the complexity around assessing the risk is very, very different. Look at the peer-to-peer end of the market. If you're lending on a property lending portal and you've got an idea of what the property is and the loan to value, it's fairly simple. That is much easier for Joe Bloggs on the street to assess, and I think to make a investment decision on. So I think again it's a matter of choice and dissecting the market. But I think there's a demographic at play as well, which is where people who've been around towards the end of their career, I think will favour much more managed funds and the approach there. Whilst if you look at Gen Z and the younger generation who want apps at their fingertips, they may choose to have exposure via managed funds, but I think more and more people are looking for the direct approach, having the choice at their fingertips, and I think again it's horses for courses.
Yeah, interesting. No, I agree. Certainly there are lots of different avenues which are being opened up to allow people to get exposure, whether it's through the managed routes or directly. But it's interesting to think about which other segments which are more intuitive for direct investors, because I think those are the areas where there's going to be a lot more conversation happening. One of the things I wanted to kind of finish with before I ask you about your view on where to invest, what is Fidelity doing to drive forward innovation, and what is your view on partnering with financial technology companies and other outside vendors?
Fidelity's been around innovation for a very long time. We've got a private equity arm that has been investing since the 60s in technology. We've got a venture arm that has been very active in looking at, in financial services, strategic investments that align with what we're looking to achieve on the asset management side. So from an innovation point of view, we're extremely active. especially thinking about how to bring investment platforms into the modern age. And one of the things I think we're absolutely active on is thinking how you can build operating models that are efficient to achieve democratization of different asset classes, and especially private markets. And one of the challenges the asset management industry is going through is not only very old-fashioned trading systems and trading models in some parts of the market, but also the administration of the whole industry. And much of the industry is still administered in an old-fashioned way with custodians and administrators, and it's not only hugely inefficient, but it's hugely it's very costly. So there's a lot of work being done to see how to involve tokenization technology or digitalization in the market and provide that inefficiency and break down the barriers.
What does Fidelity do in order to basically push forward that agenda, for example, tokenization of private assets, for example?
So as I mentioned, we've got a team on it, the venture capital team, who are looking at all sorts of platforms all the time and having dialogue with participants across the industry. And this is sponsored from the very top of the firm. I think there's a acknowledgement that this is a huge growth area that is set to continue, and we're going to see massive structural change across the industry, and therefore Fidelity needs to be part of it.
Okay, excellent. Finally, before we finish and maybe open up the floor for questions if we've got some time, very interested in understanding what is Fidelity's view of where the value is in different asset classes over the next 5 years.
The wonderful thing about Fidelity is that there's a lot of different people in the firm who have different views, and we discuss and debate all the time. So I'll certainly try and give you some of the views of Fidelity, but a lot of these will be my own personal views. But shall I just start on an open-ended way? I think, if I was to characterize where we're at in 2024, we've seen over a decade of very cheap money that has fueled growth in asset class returns across the board. Whether that be in equities financed by cheap investment grade money and the ability to issue long-dated cheap bonds and buy back shares and boost share valuations. And we've seen, I think, growth of valuations again fueled by declining interest rates and QE. And that's also led to a lack of dispersion of performance across the market, because capital's been flowing freely to different parts of the economy, and allowing also weak businesses with weak business models to continue to exist. And I think now with the shift in interest rate regime, we're going to see a very different environment where capital actually costs something, and businesses which do not generate a return on capital will struggle. So the next few years are going to be particularly interesting, but I think whilst there's been a very quick adjustment in the fixed income markets to the interest rate environment, and we continue to see that fairly rapid adjustment, I think there's been a much slower adjustment in other parts of the markets, namely real estate and I think equities as well. In real estate, when you have interest rates at 4 or 5%, and without additional margin premiums that mortgage providers charge, and you then have rental yields continuing to be at 2, 3, 4%, it doesn't really make any sense. So something has to happen. Either rates have to come crashing back down, or valuations need to adjust. And the same thing really is true for equity markets. And what we've seen is the cost of the risk-free rate go up, and equity markets did suffer from performance in the last couple of years, much of which has recovered, or to some extent. But you see the equity risk premium still be very, very tight, and I think that's really where I'm more concerned about, and I would say that because I'm a credit investor, but I think, you know, valuation discovery still needs to happen in this new rate environment. On the flip side, if you think about being a fixed income investor, you are actually getting income, and you're getting pretty attractive income, and that goes for public and private credit. And so if you can take a secured position in the debt of a company and get paid very high single-digit returns, if not double-digit in some instances, that's a very attractive position to be in. And so I think, you know, being invested across, you know, the fixed income market as well as private credit market is particularly attractive in this environment. And given the uncertainty of valuations, I would want to favour the senior part of the capital structure.
Yeah. I'd like to thank you, Michael, for joining us tonight. That was certainly very interesting, getting a view from, you know, one of the largest institutions in the market, how they're thinking about things. Maybe I can just open up the floor to questions. You know, we'll take 3 or 4 questions from the floor.
You've got Fidelity there, you've got WiseAlpha there. Fidelity, where might you put WiseAlpha on your platform choice?
I think that's quite an easy one, in the sense that Fidelity's in the business of offering managed funds, and so you know, it's probably not appropriate for Fidelity, but it's essentially what WiseAlpha does is offer investors another choice. Just like at Fidelity we manage public equity funds, but people can go on Hargreaves Lansdown or their stockbroker and buy Marks and Spencer shares. You know, people want to have a choice and, you know, an alternative, and be able to buy bonds on WiseAlpha's platform. Hopefully that covers it.
Does the potential of AI scare you or excite you, and why?
Okay. Why don't I give that over to Frank? Why didn't you have a go?
Excited and terrified in equal measure, I think. We've been implementing it in various different ways, and we've really focused on efficiency, so not as a replacement for kind of diligence or thinking things through, but kind of to make us more scalable, launch campaigns quicker, make them sort of run better. A concrete example would be, I mentioned earlier that we verify all the claims that we do for the campaigns. So one thing we're looking into is using AI to sort of look through pitch decks and then create a pitch page based on the information that we find there. It's always checked by a person, but that's usually quite time intensive and rigorous. Speaking more specifically on the marketing side, which is more my domain, we're using it a lot to help us automate processes that were done manually. Being done manually are prone a little bit to error, so kind of AI helps us on that side. But yeah, I think both really in equal measure.
We have pretty strict rules around who can access our market, and so it doesn't really concern me too much, AI. In general, from a humanistic perspective, it absolutely excites me because I'm a technologist. I can just see the power of this thing coming, being able to use it in our sales processes, in our other marketing material, that sort of thing. It can only be powerful and good. Like all things, it needs to be managed effectively, but super exciting. I think it's the way forward.
Just a bit of background. I've just recently retired as a fund manager, a fixed income fund manager. So one of the things, and I think this was said by the whole panel, and I think just to reiterate, is education. So I retired sometime a few months ago, and just trying to, and I don't know if this is for the audience, but just picking up a paper, trying to find out what's going on in bond markets. It's an absolute disgrace what is going on, which is a huge market. Government bonds, T-bills, and corporate bonds. And this sort of initiative that we've got is a really, really important part. And you know, and maybe this is why regulators struggle, because they just don't understand fixed income. And this is really quite important that we are doing this education process, because what I found very difficult is we are able, and I think Reza, you touched upon this, we can buy the riskiest part of the capital structure, either through managed or Joe Blogs picking up their Revolut app and buying a share. But you ask them to go and buy a Vodafone 5-year bond, nice safe credit, people sort of roll their eyes and go, what are you playing at? So I think this is absolutely key to understanding why this sort of innovation, this sort of platforms more broadly should exist. And maybe go back to Michael's point on fidelity. And again, it's about coexisting. You can have a coexistence of an individual instrument with a managed product. Just as you have with equities, you should be able to buy a corporate bond and a managed bond fund, hopefully Fidelity's or one I used to manage, but it can coexist. And I think this is part of that whole process that all of us are obviously interested in, but it really is quite important.
Yeah, no, I totally agree, and that's obviously why we've dedicated our time in order to democratise and open up access to the corporate bond markets. And I think there's certainly been a recognition of that recently. Both the regulators with their recent paper talking about that topic, but also other in other countries people are talking about the same initiatives. So I think there's going to be a big change over the course of 2024. We'll be leading that. We'll be talking with other parties as well about it. But yeah, no, totally agree. Look, for products like corporate bonds, which are relatively low risk, they should be made more widely available. People should have that choice to decide whether they want to buy a fund or an individual bond in a company that they know and use. Okay, one more question we got at the back.
Sure, thanks. This is a quick one, really. I guess it's directed to all of you up there. How do you see the political situations across multiple parts of the world affect the markets moving forward? Because it seems like we're getting very close to territory that I've never witnessed in my lifetime. It'd be interesting to know how you foresee that happening.
Well, I mean that's a fairly broad question. I mean, politics is I would say just generally I think politics is driving a lot of what you see in terms of volatility in the markets, and just in general the way that we are living our lives at the moment. But the one thing you can always count on is that markets will always be there, and volatility or different value in different segments changing as a result of different things like inflation will always create opportunity, right? So there's money to be made, and I think it's just a case of being a little bit smarter, in terms of kind of monitoring all that. But at the same time, politics can be unpredictable, and it can be very variable across different countries. So, it's definitely something that's become more important these days, I think, in terms of working out where things go.
I was hoping to dodge that one, but I think you covered that pretty well, Reza. Just to follow on, geopolitical risk is huge at the moment. You've seen what the Russian invasion has done to the inflationary environment, and now you see what's going on in China and US-China relationships, which will most likely cause long-term inflationary pressure, because virtually anyone who has sourcing in China will now have sourcing in China plus one other country at least, and that will cause inflationary pressure. So I do think, whilst inflation is coming down at the moment, there is going to be long-term elevated price inflation versus where we've had it the last 10, 15 years. As it relates to this year, we've got elections, and you've seen huge borrowing in the US. Never seen such huge borrowing in peacetime, and that's obviously creating growth. What's going to happen towards September, October as the inflation result gets close? I think probably more volatility once that kind of stimulus and support to the markets potentially goes away.
One thing before I ask you guys, I think that this being an election year, the one thing you can count on is that there will be events. That's the one thing I'll say.
Back to the original point, I guess everything's cyclical, right? So if you look back to 2006, 2007, it was not a great time, but particularly on the tech side, the businesses that came out of that were world beaters now. So it's always, I think, maybe looking not just now 1 year ahead, but 5 or 10 years, as is, I suppose, good practice. And the other thing, just to build on your point about elections, is it's not just the US. I think there's about 4 billion people in total who are doing elections this year. You've got India, Indonesia, UK. So yeah, who knows really? Is an honest answer.
For us at JP Jenkins, we like volatility. We want volatility that presents opportunities for our clients, and so that let's just leave it at that. We think is a good thing.
Thank you very much for all the amazing stuff that you have shared with us today. You know, for retail investors, it has never been, you know, as cheap and as easy as it is today to invest money, because, you know, nowadays we have applications like Trading 212, Free Trade. Me and my friends, we work in a new trading app, and everything is practically cheap. I mean, free. So if you want to invest, I don't know, in an ETF, in a share, whatever, it's free. So basically, these days, the feeling that we have right now, and we are like striving, struggling to find a way to monetize the application that we are working on, is because these days it seems that the product is the price, basically, because everybody is offering the same thing. Everybody is offering, you know, access to the same type of assets, and it's basically free. So in your opinion, if you will have to start today from scratch, what do you think that you will have to do, you know, to find your place in the market and provide something innovative? Because right now we are in a market that, you know, for retail investors is amazing because it's very cheap and it's very easy. But if you are a new player in the market, it's really hard to make money. Really, really, really hard to make money. So what do you think that you project?
Yeah, I mean, look, you know, we're an entrepreneurial firm. I mean, we obviously started a fintech. I think it's probably particularly interesting for me to answer this question. I mean, but I think these days, you know, on all the products which are, you know, commoditized, where there's lots of players, you know, I think it's incredibly difficult to start afresh unless you have some marketing spin or some way or some partnership already with a large organization that's going to give you an edge. I think innovation in new product areas, or where there's a differentiation which is going to give you an edge, that will continue, you know. So I think you want to I think either you have strong support from the beginning, you know, in a product which is where there's already competitors, you have support from some other player, or, you know, something that gives you, you know, some financial clout to kind of get you to market in a scaled way, or you find a product which is going to be differentiated and you can market that and build your base.
You're right that it's a very competitive space, and maybe 4 years ago it would have been, you know, distribution trumps everything else, so find a way to grow at all costs. Not quite, but, you know, now it's much more about profitability and kind of how sustainable you are. For us, we talk a lot about kind of moats that we have as a business, because the retail space is very crowded. One of ours, which was, it's not applicable to you, but it's our regulatory moat. So we talked about the importance of regulation earlier. Getting FCA regulated is actually very tough for a new business. We talked to a lot of businesses, you know, we're quite well connected in the space, who have done everything else, but they just need their FCA accreditation, and that's a massive hurdle to get beyond. So that's kind of, I think, finding, as Reza said, maybe a unique angular aspect that you have and kind of building on that.
I'll wrap things up there, but it's a pleasure to see so many people here tonight, you know, who've, you know, got interesting views about, you know, all the topics we discussed. And so look, there should be some time afterwards if you want to come up and speak directly to any one of the panelists this evening, you know, over a few canapes, you know, to discuss these things further. But, you know, thanks very much for listening to us speak, and I hope that was informative. And I look forward to chatting with everybody here, you know, over a few drinks on the campus. Thank you.